The S&P 500. For decades, it's been the cornerstone of investment strategies. A reliable, steady climb towards financial security. Even the legendary Warren Buffett famously recommended it as the ideal investment for most people. But is that still the case? With economic landscapes shifting and market volatility on the rise, many are questioning if the traditional investment playbook still holds true. Whether you're just starting out or nearing retirement, the weight of investment decisions can be overwhelming. Should you stick with the tried-and-true S&P 500, or is it time to explore other avenues? Let's cut through the confusion and equip you with the knowledge to make informed decisions about your investments. Welcome to Sage Investing, bringing you timeless investing wisdom. If you're looking to improve your investing knowledge, make sure to subscribe and hit the like button if you found this useful. Many investors seek a straightforward and reliable way to grow their wealth without extensive market research. Index funds provide a popular option for most people, but is it the right choice for you? The S&P 500 is basically the superstar of the U.S. stock market. It's a giant snapshot of the 500 biggest companies in America. Since it represents a whopping 80% of the total U.S. stock market value, it's like the crystal ball for how the overall market is doing. So, if you want a piece of the American economic pie, the S&P 500 is a solid starting point. When you invest in it, you're actually buying a tiny piece of all those companies at once. It's like owning a little bit of Apple, Microsoft, and hundreds of others. Now, the cool thing is, the bigger a company is, in other words, the higher the market cap, the more it counts in the S&P 500. Currently, Apple is the biggest company on the planet and has a current weighting of 6.87%, followed by Microsoft and Nvidia, and so on. An S&P 500 index fund is like hiring a really smart but lazy financial advisor. Instead of trying to guess which stocks will soar, it simply copies the S&P 500. This passive approach means super low costs for you. We're talking pocket change compared to other investment options. For example, a Vanguard S&P 500 index fund only charges 0.03%, or $300 per year, for each $1 million invested. Plus, you get diversification without lifting a finger. Your money is spread across a bunch of different big-name companies in various industries. It's like owning a little bit of everything in the U.S. economy. You're not putting all your eggs in one basket, which can help protect you from those wild market swings. The companies in the S&P 500 aren't set in stone. They can change if a company gets added or dropped from the actual index. Plus, the S&P 500 is pretty well spread out across different industries. No single sector hogs all the money. This is great because a lot of funds go crazy for things like tech or finance. So investing in the S&P 500 is like getting instant diversification without having to be an investment expert. Tech is the biggest player in the index, which makes sense considering how much it's part of our lives. Now, you might think that owning a piece of 500 companies would mean you're super diversified, right? Well, not exactly. There's a catch. Just 7 companies called the Magnificent Seven own nearly a third of the whole S&P 500. So, while you're investing in 500 companies, you're actually really betting on these 7 giants, at least at the moment. One cool thing about the S&P 500 is that not just any company can get in. There's a club, and you have to meet some pretty strict requirements to join. A group of smart people called the U.S. Index Committee checks out companies to make sure they're financially healthy and stable. To qualify, a company needs to be based in the U.S., worth at least $8.2 billion, have lots of shares available for trading, and be making money. Plus, the stock price can't be crazy, and the company needs to have been around for at least a year. You might remember the big deal about Tesla trying to get into the S&P 500. Well, the committee said no for various reasons, but that didn't stop it being included in the index a few years later. So, should you invest in the S&P 500? Well, you have to keep in mind the pros and cons of index funds. They're passively managed, meaning they simply track the index, which keeps costs low and attracts plenty of investors. Plus, the S&P 500 offers pretty good diversification across various industries. However, when it comes to returns, index funds like the S&P 500 might not be the superstar. If you're satisfied with average market returns, it's a solid choice. But if you're aiming to outperform the market, you might want to explore other options. One alternative is to invest in a growth stock fund that focuses on the S&P 500. These funds select the fastest growing companies from the index, giving you the potential for higher returns. While they might carry slightly more risk, the long-term rewards can be substantial. A great example of a growth fund is Vanguard's S&P 500 Growth Fund. It picks over 200 of the fastest growing companies from the S&P 500. Now here's the kicker. Over half of this fund is invested in tech companies. That's where the big growth potential lies, but it also means a bit more risk. You still get exposure to other sectors like utilities, real estate, and finance, but these parts of the fund grow at a slower pace. Let's talk numbers. From 2009 to 2019, the overall S&P 500 did pretty well, gaining almost 14%. That's solid, especially considering it was a bull market. But growth funds absolutely crushed it. In 2019 alone, the S&P 500 climbed a bit over 31%, while the best growth funds were soaring past 40%. It's clear that growth funds can generate significantly higher returns. It's important to remember that not all funds are created equal. Some underperform the S&P 500, so careful research is essential. Ultimately, the best investment for you depends on your financial goals, risk tolerance, and time horizon. Alright, so there you have it. The S&P 500, it's like the classic, reliable car of the investment world. It'll get you where you need to go, but it might not win any races. If you're looking to hit the gas and really zoom ahead, growth funds could be your turbocharger. But for those who are just starting out their investing journey, it's a great place to start.